Good morning, everyone. Thank you for being here today. My name is Bini Amali. I am a graduate student in data science and analytics at the University of Oklahoma. This presentation is part of my course project for financial engineering analytics course under the guidance of Dr. Theodore Travalis. Today, I will be discussing the topic of portfolio optimization using mean variance analysis. This presentation aims to provide an in-depth analysis of mean variance optimization, a critical method in portfolio management. We will cover the methodology, data collection, calculation of key metrics, optimization process, and performance evaluation. Portfolio optimization is a fundamental concept in investment science, central to the field of modern finance. This project focuses on applying portfolio optimization using mean variance analysis, a key framework introduced by Henry Markowitz. The objective is to construct efficient portfolios that either maximize expected return for a given level of risk or minimize risk for a given level of expected return. Drawing on principles from investment science by David Lundberg, this project delves into quantitative methods that underpin portfolio management and asset pricing. David Lundberg emphasizes quantitative method in investment science. Henry Markowitz introduced mean variance analysis, key to modern portfolio theory. Expected return, weighted average asset returns, while variance measure of return dispersion, sum of variances and covariances. Covariance assets move together, positive, inversely negative. Efficient frontier optimal portfolios with maximum return for a given risk level. Objectives. First, we aim to apply the mean variance analysis framework introduced by Henry Markowitz to optimize our portfolio. Second, we will gather historical financial data from reliable sources to ensure our analysis is based on accurate and comprehensive information. Key metrics such as expected returns, variances, covariances will be calculated to understand the risk-return portfolio of our assets. We will then identify the optimal mix of assets that either maximize returns from a given level of risk or minimize the risk for a given level of expected return. We will evaluate how diversification affects the overall risk and return of portfolio, emphasizing the benefit of spreading investment across different assets. By applying our optimized portfolio to historical data, we will assess its performance and validate its effectiveness in real-world scenario. Data collection and processing. Here we gather and clean historical financial data from selected sources to ensure accuracy and reliable for analysis. Calculation of expected returns and covariance metrics. Here we compute the expected returns for each asset and covariance metrics to understand the relationships and risk associated with assets. Then we will move to the portfolio optimization. In this case, we use optimized techniques to determine the best asset allocations that maximize returns for a given risk level or minimize risk for a given return. Performance evaluation. Here, we evaluate the performance of optimized portfolio through backtesting, assessing its robustness and effectiveness using historical data. Data collection. The data from this analysis was obtained from Yahoo Finance, a trusted and widely used platform that provides extensive historical financial data, essential for accurate backtesting and analysis. A diverse set of companies was chosen to ensure comprehensive analysis. Those companies span various sectors, as you can see here, including technology, consumer dictionary, discretionaries, communication services, and healthcare and financial sectors. Various are packaged were utilized to streamline the analysis process. Quant mode used to facilitate efficient data extraction from Yahoo Finance. Performance analytics used to enable detailed return calculation for each asset. Quad used for analyzing the portfolio by solving quadratic programming problems. The implementation of mean variance analysis began with the data collection and pre-processing. The quantum mode package in R is utilized to efficiently and effectively retrieve the historical price data for the asset under consideration. This step ensures the data is accurate and comprehensive for subsequent analysis. After obtaining a historical price data, daily returns are calculated. Those returns provide insight into day-to-day performance of each asset, which is a crucial assessing their risk and return characteristic. For example, selected assets include major technological company like Google, Microsoft, and Apple. Calculate the expected return and covariances, which is the second step in implementing mean variance analysis. The expected return for each asset were calculated using historical data. For instance, in figure 3, Tesla has the highest average daily return, suggesting high profitability, while Johnson & Johnson has lowest, indicating more modest performance. The covariance metrics offer a detailed look at the risk and how assets move in relation to each other. The matrix measures how the returns of different assets move together. Diagonal elements represent the variance of each asset return. In a figure, for example, Tesla has the highest variance, reflecting its high volatility. Of diagonal elements show the covariance between pairs of assets. For example, a positive covariance means assets tend to move together, which can increase risk if they decline simultaneously. Both the expected returns and covariance matrix are calculated in construction and optimal portfolio. Expected returns help estimate potential profitability, while the covariance matrix aid in understanding and managing portfolio risk. Now we are on the third step in mean variance analysis, portfolio optimization. Here the goal is to find the optimal asset allocation that balance the trade-off between risk and return using quadratic programming. Here we have optimal weights for each asset in a portfolio. Figure 5 shows the specific allocation for each asset, where positive values indicate proportion of portfolio allocated to each asset and the negative value indicate short positions. The fourth step in implementing mean variance analysis involves constructing the efficient frontier. The efficient frontier is a graphical representation of optimal portfolios that offer a highest expected returns for a given level of risk. To plot the efficient frontier, we use calculated portfolio risks and the returns. The plot function creates a line plot with the portfolio risk on x-axis and the portfolio return on y-axis, as shown in figure 5. Each of the efficient frontier corresponds to the portfolio that offer a highest expected return for a given level of risk. The blue line represents the efficient frontier showing the optimal portfolios. The red point indicates the minimum variance portfolio, which has the lowest risk among the possible portfolios. The fifth step in mean variance analysis is to analyze the result obtained from constructing the efficient frontier. This involves examining the optimal portfolio weights, expected return, and risk for a minimum variance portfolios. The optimal weight for minimum variance portfolio are extracted and displayed here. The weight represents the proportion for each asset in a portfolio that minimize risk for a given level of return. Interpretation of some of the allocation. Apple 4.6% moderate allocation contributing positive but not dominating. But if you see, for example, Google is 6.61, positive contribution to achieve target return and managing risk. And if you look Johnson & Johnson, which is the largest allocation, acting as stabilizer due to the low volatility. The optimal weight reveals a strategic allocation across various assets to achieve the lowest possible risk. Significant allocation to Johnson & Johnson underscore its role as a cornerstone for stability. Other assets like Alphabet, Amazon, and United Health contribute positively to the portfolio return. The negative weight for Microsoft highlight its use as a hedge tool to manage overall risk. This analysis provides a clear understanding of how to construct a well-diversified portfolio aligning with risk tolerance and return objectives. The final step in implementing mean variance analysis is backtesting the optimized portfolio without of sample data. This step is crucial as it provides insight into how well optimized portfolio performs in a real-world settings. So first, we apply the optimized weight obtained from in the sample optimization process to out of sample data. We calculate the portfolio return by multiplying the returns of each asset by their respective optimized weights and as summing those weighted returns for each period. We then calculate key metrics to assess the portfolio performance during the out-of-sample period. Mean return. This measures the portfolio ability to generate returns, indicating modest gain. Volatility measures the degree for variation in returns with value, suggests moderate risk. The Sharpe ratio measures risk-adjusted return with value, indicating that returns are not significantly higher relative to risk. The mean return is relatively low, indicating modest gain during the out-of-sample period. Volatility suggests moderate level risk with some volatility in a return that needs careful management. Now let's examine the out-of-sample performance graph of our optimized portfolio. Initial growth phase. Portfolio shows a strong upward trend from early 2021 to late 2021, indicating robust performance and effective risk management. Volatility and fluctuation. Starting from early 2022, the portfolio experiences increased volatility with noticeable peaks and troughs. Decline phase. From mid-2022 onwards, the portfolio exhibits a downward trend, reflecting challenge in maintaining positive return. Overall performances. Despite the fluctuations, the cumulative return remains positive for stability part of the period. This suggests resilience. Findings and insights. Key findings. Mean variance analysis successfully obtained the portfolio balance risk and return. Efficient frontier provided clear guidance on optimal risk-return trade-off. The portfolio optimization strategy highlighted the importance of diversification. Insights. Diversification effectively reduces risk without significantly compromising return. Secretarial allocation demonstrated the significance of strategic asset selection. Backtesting results indicate robustness of optimization model in a real-world scenario. This project successfully applied mean variance analysis for portfolio optimization, confirming the principle introduced by Henry Marcuse and detailed in Investment Science by David Lundberg. We utilize historical financial data from Yahoo Finance, encompassing a diverse set of companies across various sectors. We calculated expected returns, the covariance matrix, optimized the portfolio using GAP. We constructed the efficient frontier, which provided a clear visual guide for understanding optimal risk return for return trade-offs. Backtesting played a crucial role in validating the robustness of our optimized portfolios, ensuring their effectiveness in real-world scenarios. Key takeaways. This project highlights the importance of quantitative methods in portfolio management. We demonstrated that mean variance analysis is a valuable tool for maximizing return and managing risk, aiding in a development of informed investment strategies. In summary, this project underscores the power of mean variance analysis in constructing efficient portfolios. By leveraging quantitative methods, we can balance risk and return effectively, leading to more informed and successful investment strategies. Here are my references. Thank you very much for listening.